The Defiance Nasdaq 100 LightningSpread Income ETF ticker symbol QLDY is an actively managed fund designed for investors seeking very high income with exposure to the Nasdaq 100 index. It uses a sophisticated option strategy called the LightningSpread, which combines synthetic stock exposure with the sale of short-term options to generate consistent premium income. The fund was created to provide frequent distributions to shareholders while maintaining some participation in market growth. Its main goal is current income, and its secondary goal is limited capital appreciation. Instead of owning shares of Nasdaq companies directly, QLDY gains exposure through deep-in-the-money call options. These options behave similarly to owning the underlying index but cost less and can be adjusted more efficiently. At the same time, the fund sells short-term put spreads that expire in 1 day, also called zero-day to expiration or zero DTE options. By selling these options, the fund collects small amounts of premium income that add up over time. This option premium is the main source of the distributions investors receive. The fund aims to pay distributions twice a week, which is far more frequent than typical monthly or quarterly payouts from most exchange-traded funds. However, investors should understand that a large portion of these distributions may include what is called return of capital. Return of capital means the fund is giving investors back part of their original investment rather than distributing profits. Every time this happens, the net asset value or NAV decreases. Over many weeks, repeated return of capital can slowly reduce the size of the fund's assets and make it harder for future income to stay stable. Defiance clearly states in the prospectus that distributions which include return of capital will decrease the fund's NAV and share price over time. This is an important warning because it means that while investors receive frequent payments, the total value of their holdings may shrink. The LightningSpread structure is designed for income generation, not for long-term growth. The combination of synthetic exposure and daily option selling can create consistent cash flow but will likely result in limited upside compared to simply owning the Nasdaq index. Investors are trading potential growth for consistent yield. To understand QLDY properly, it helps to look closely at how its strategy functions each day. The fund begins by holding deep-in-the-money call options to gain exposure similar to owning the Nasdaq 100. This allows it to move generally in the same direction as the index without needing to own every stock. Then it sells very short-term put spreads on the same index. These positions expire the same day they are opened. Because they are short-lived, the fund collects premium income from time decay. Each day the process resets and new option spreads are written. This approach allows the fund to capture small, frequent profits from options while still keeping some exposure to overall market direction. However, it also means the fund relies heavily on volatility. When the market is volatile, options become more expensive and the fund collects higher premiums, resulting in larger income distributions. When the market is calm and volatility falls, the option premiums shrink and income drops sharply. In those low volatility periods, the fund may maintain its payout by returning capital to investors, which accelerates NAV erosion. Another effect of this structure is capped upside. Since QLDY sells options, it earns income in exchange for limiting how much it can gain if the Nasdaq rises strongly. During big rallies, the fund's gains will lag behind the index because of the sold options. But when the market falls, the fund still bears most of that downside risk. This makes QLDY asymmetric. It performs best when the market is moving sideways with moderate volatility because that is when option premiums are highest relative to risk. The twice-weekly distribution schedule also increases the operational cost of running the fund. Every week, the managers must rebalance option positions, handle settlements, and prepare payouts. These additional costs come out of the fund's assets and slowly reduce NAV. Over months and years, the effect compounds, similar to paying fees multiple times more frequently than other E. The structure of QLDY makes it both innovative and risky. The income potential is high, but the stability of that income depends almost entirely on market volatility and trading efficiency. The strategy requires constant monitoring and adjustment to stay effective. The managers use active trading techniques to manage exposure, balance premiums, and limit losses, but execution risk is always present. Because the fund operates with synthetic options and daily trades, even small pricing errors or slippage can affect returns. Defiance designed QLDY to appeal to investors who want cash flow rather than capital growth. The fund's distribution frequency and marketing focus attract those who prefer to see money flowing into their accounts each week. However, this frequent payment schedule can create a psychological illusion of profitability. Many investors see consistent payouts and assume the investment is performing well without checking whether the NAV is falling. A good rule of thumb is to track total return, which includes both the income received and the change in NAV. Only by combining those two numbers can an investor know if they are truly earning or slowly losing capital. The lightning spread concept is meant to extract short-term option premiums efficiently, but it is still tied to macroeconomic forces. If the Nasdaq becomes too calm, income falls. If it becomes extremely volatile, the fund's short options could lose money rapidly. Either extreme creates problems. Additionally, QLDY's heavy use of return of capital means investors could be taxed differently than they expect. Return of capital is not taxed immediately but reduces cost basis, potentially leading to larger capital gains later when shares are sold. Another risk factor is fund size. Because QLDY is new, its assets under management are relatively small compared to established ETFs. Smaller funds can face liquidity challenges which make trading more expensive for investors. Wide bid-ask spreads and low volume can increase transaction costs. Looking ahead, QLDY's success depends on whether it can maintain high option premiums and stable payouts without depleting NAV too quickly. In a healthy volatility environment with moderate swings in the Nasdaq, the fund can produce strong income with manageable erosion. In a long calm period, income may drop, forcing the fund to rely more on return of capital. In a severe downturn, short option positions could cause losses, reducing both NAV and distributions. The fund's appeal lies in its ability to create frequent income, but the trade-off is that it sacrifices long-term growth potential. For short-term income generation or tactical use, QLDY may fit well in a diversified portfolio. However, for long-term investors seeking compound growth, it may underperform traditional equity or balanced funds. My meter rating is as follows. Income potential 8 out of 10 because of its aggressive option structure and frequent payouts. Risk 5 out of 10 since exposure to volatility and synthetic derivatives adds complexity. Sustainability 4 out of 10 due to dependence on high volatility and heavy return of capital. Execution and flexibility 6 out of 10 because of its active management and adaptive nature. Overall, my meter rating is 6 out of 10. QLDY is best suited for experienced income investors who understand options and can accept principal erosion as part of the trade-off for high yield. It is not a traditional buy-and-hold product. Instead, it behaves more like a short-term yield instrument that rewards attentive investors who monitor NAV trends closely. If the goal is stable weekly income with awareness of underlying risk, QLDY fits that description well. If the goal is long-term growth, more balanced ETFs would be a safer choice. If you have any videos you would like me to cover, say it in the comments below and I will break it down in plain English.